Hello everyone, I am Aisha Salman from ASA and welcome to today's webinar. In this session, we will review the highlights, answer your questions, and offer suggestions on to how companies can get the most from the results of the American Supply Association 2018 Operating Performance Report, called the OPR. Please note that this one-hour webinar is being recorded for replay. Everyone registered for this webinar will receive a follow-up email with notification as to when the replay is available, as well as instructions on how to access it and the presentation slides as well. Before we get started today, I'd like to recognize our 2018 supplier partners who are truly dedicated to the positive development of the PHCP industrial mechanical PVF industry through ASA. When making key decisions in your business, please consider these corporate partners that go above and beyond with their support to advance the association's efforts, programs, and services through advocacy, education, networking, and business intelligence. One of the association's strategic goals is that ASA members will be more profitable and sustainable as they deliver world-class supply chain efficiency in a changing marketplace. For 36 years, ASA has partnered with Industry Insights, Inc. to provide the only source of industry-wide financial and operating performance benchmarks for the PHCP and the industrial mechanical PVF wholesale distribution channel. Today, the annual OPR is part of a total suite of business intelligence reports that provide ASA members with reliable and timely industry data to use when making strategic decisions that fuel growth. ASA also partners with Industry Insights to produce a monthly flash report on profitability, sales, inventory, headcount, and average day sales outstanding, as well as confidential business valuation appraisals. Our presenter today is Tom Noon, who founded Industry Insights in 1980. Tom's expertise includes the areas of financial analysis, business valuations, profitability planning, and productivity improvement strategies. He has served as project director in a variety of research and consulting studies for both U.S. and European public and private firms, as well as numerous trade and professional associations. Additionally, Tom has played a major role in both the design and the presentation of executive development programs in the United States and Western Europe. As you read the Wall Street Journal, U.S. News and World Report, and a number of other trade magazines, you may see Tom quoted. One last note before I turn it over to Tom. We encouraged to ask questions throughout this presentation. Your GoToWebinar control panel includes window panes in which you may pose questions and even chat with other participants through the use of your computer's keyboard. Tom will periodically pause for questions. There are also program attachments on this control panel for your reference. If needed, you may minimize and maximize the control panel by clicking on the orange arrow in the upper right-hand corner. That concludes our general information as at this time, I will turn the program over to Tom.
Well, thank you very much, Ayesha. I appreciate the opportunity to be here with you all today, and I especially thank ASA for having given us the opportunity to be involved with the OPR for 36 years now. And yours truly has been involved since the beginning, and that's been a great honor. As you know, the Operating Performance Report is a benchmarking type study. It is designed to provide you with barometers against which to compare your own company's performance. What I would like to do in the session today is talk about the OPR from the standpoint of how you can use it, what the kind of information is in this study, but also show you the results of this year's study, which is the 2018 OPR of 2017 results. So what you see on the screen here right now is kind of the outline I'll be following in the session. I want to spend just a few moments up front talking about why this information is important and some of the important features of the study. Then I'll get into the actual highlight results of this year's study on an overall basis and looking at that over a historical perspective, and also looking at it by individual segment. Then I'm going to spend a little bit of time taking you through a hypothetical case example company. The idea here is that we can see in a very short period of time how great insights about a business can be determined using the OPR, and you don't have to be a financial expert, and as I said, you don't have to spend a lot of time doing it. So hopefully seeing me do this in a few minutes, it'll be that much easier for you to do the same thing for your own company. Then I'd like to shift gears and do something we do in this study every year, and that is look at the profit leaders. These are the most profitable companies in the industry for each of the various segments that we track. And the idea here is to try to identify what leads to high profitability among PHCP wholesalers. And hopefully you are already among that group of wholesalers, but if not, by looking at the high profit companies, maybe it'll make that much easier for you to get to that level yourself. And then at the end, I'll draw some conclusions as to what we've learned from doing the study for 36 years and give you some tips for getting maximum advantage out of it. So that's kind of the direction that we're going in the session here today. I'd like to point out that the study is really two reports. As a participant in the study, your company, and in particular the person who is designated to receive this confidential information, we receive two separate reports. The report on the left is the full industry-wide report that has all the data groupings for all the different segments of the industry. It has analysis, ratio definitions, and basically includes all the information. The report on the right is the individual company performance report, or CPR as we call it. And this report, in my way of thinking, is the most valuable component of this study, because this is a customized, confidential report about your own business that shows your company's ratios already calculated and shown alongside the data groupings for companies most like yourself. So hopefully it's a fairly easy process to analyze your company's strengths and weaknesses. Both reports are available as a PDF document, so you can print out as many copies as you want, but the individual report is made available to you both as a PDF document and also as an Excel document. So if you are inclined to do further analysis, you can just put it right into Excel and do it that way. Now, I'd like to emphasize that these reports are strictly confidential, so you should treat them that way within your own company. And obviously, we at Industry Insights go to great extremes to ensure confidentiality throughout the process. Okay, in your individual report, there are several different segments of this report, and I just want to briefly familiarize you with it. Many of you are already familiar with these, but I just want to briefly mention it. There's something we call a report card, or a summary performance evaluation. And what this does, it looks at some key measures and tries to give you an indication whether or not your performance is strong, good, fair, or poor for those particular measures. Now, this isn't perfect because a lot of ratios are interrelated, but it does give you an indication of possible red flags of things you might want to look at in more depth. Now, in addition to the report card, there is also trend information in the study, because it's important to look at yourself versus the industry benchmarks, but it's also important to look at yourself versus how you've compared over time. So we are able, if you've participated in consecutive years or a number of years, to show your results for the past 5 years, if you've participated for the last 5 years, for all the various ratios. And we show it in both in graph form and tabular form. So what you see here is the graph version. This takes a look at one measure, net profit before tax to total assets. And the solid line on this graph is your company's results. Now, obviously, these are hypothetical numbers because this company happened to do exactly the same for this measure every year. Obviously not likely. Also on this graph is a red dotted line, that is the industry typical company for that measure. So you can see if you are above or below the typical company, you can see if you've trended up or down, and you can see if the industry has trended up or down for that particular measure. The shaded area represents the upper and lower quartile, or the middle 50% of companies for that particular measure. So again, you can see if you are inside or outside the middle 50%. Our sample company here actually is below the middle 50%, so that would be a red flag in my mind. Okay, the information in the trend section of your individual report also shows your results over the last 5 years. Again, these are hypothetical company numbers. That's why they're exactly the same, because I want to emphasize that they are hypothetical. We would never, ever show anybody's actual numbers. In addition, in your individual company performance report, or CPR, there is what we call the detailed performance measures. And for all of the measures in the study, it calculates and shows your firm, and then alongside your firm are the comparisons for other companies most like yourself. Now, I've just selected these comparisons here, all plumbing, all PVF, all plumbing, PVF, HVAC, and companies in your region. But for your company, it's probably going to show you versus others similar in sales volume size as you. It's going to show, if you're a PVF company, it's going to show other PVF companies of a similar sales volume. So the idea here is to try to get as close as possible to an apples-to-apples kind of comparison for you. Well, why is financial information, why is benchmarking important? Why are ratios important? Well, the main reason is just to look at the dollar figures on your P&L or balance sheet doesn't tell you all you need to know about your business. For example, if you said, Tom, we had a great year last year. We had $1 million in profit. Well, on the surface, I don't know if that's good or bad. If you had $1 million in profit and you're a $10 million sales volume company, that's 10% profit on sales. That starts telling me something. If you had $1 million in profit, but you're a $100 million sales volume company, that's 1% profit on sales. So 10% is much different than 1%. Well, just as looking at the dollar amounts doesn't tell you all you need to know, neither does looking at a ratio by itself. For example, if you said, Tom, I'm a plumbing supply company and my payroll and fringe benefits costs as a percentage of sales were 18% last year. How'd I do? Well, I wouldn't really know how you did because all industries are different, but I do know by virtue of doing this study that the typical plumbing supply company had payroll costs, including fringe benefits, that were 15.8% of sales. So if you're at 18% and your peers in the industry are at 15.8%, then that starts raising a red flag to me. You know, why are you so much higher than other companies like yourself? There may be a very good reason for it. Maybe it's not a problem, but by the same token, maybe there's a profit improvement opportunity there that can be defined. So that's why we look at ratios. But keep in mind, these are guidelines rather than absolute standards. If you see something that's out of line, the important thing is to know why it's out of line. And there may be a very good reason for it, so there may not be a problem at all. But at the same time, if you don't know why you're much different than the rest of the industry, maybe there is a profit improvement opportunity. So differences are not necessarily good or bad, but they're signals of area for further analysis. And I maintain that even a relatively simple analysis using the OPR can yield some significant benefits to you. Okay, the OPR is a very detailed study. That's both good and bad. The good part is it shows you information about a lot of different areas of your business, as you can see on the screen here. The negative part of that is it can be somewhat overwhelming. The industry report's like 95 pages in length. Your individual report is something like 20 to 30 pages of detail. There's something like 31 data groupings in the OPR, about 130 different ratios. So it's a matter of where do you start? How do you use all this information? Well, I'm going to address that during the course of this session. Now, in addition to having all this detail, we try as much as possible to get you an apples-to-apples kind of comparison. We break the data down a number of different ways. We break it by all responding companies. We break it by sales emphasis. And what that means is if you're a plumbing supply company, there's a grouping of plumbing supply companies. Your PVF, there's a PVF grouping. Plumbing and PVF, there's that grouping. HVAC and other, there is that grouping. And then within each of those groupings, we have sales volume breaks. We also do that high profit company grouping, which I'll talk about a little more. Sales volume, high profit, there's a number of branches, there's geographic region information. So we go to great extremes to try to provide you with an apples to apples kind of comparison. We also show a grouping of volume size for very large and very small companies. So if that's relevant to you, then you can find a good grouping for yourself that way as well. Okay, I'd like to mention, before I get into actually looking at the results, that this study has evolved over the years, and largely due to inputs that you provide to me throughout the course of the year, we are able to include different improvements and enhancements in the study. For example, the individual company reports, we started making electronic several years ago and now make them available in Excel also. We did a definitional change 5 years ago now in the way gross margin was defined, and I'll talk about that in a few moments. We added the regional information several years ago. And looking to next year, we have some very exciting planned enhancements that are likely to occur. For example, we're going to try to make the user interface extremely interactive. In other words, you'll be able to get on your own confidential results through a dashboard and actually define various parameters against which you'd like to compare your company and see what the industry benchmarks would be for those different groupings. In other words, if you want to define a specific sales volume group and a specific region, you can put in those parameters, and assuming there's an adequate sample size for whatever you've defined, then it'll show you right then. We call this a searchable results capability. You'll also be able to print that out as you do it. So this is going to be a very exciting enhancement for the study. To date, largely our enhancements are being sort of an evolution, but this will be a pretty dramatic improvement. Okay, let's look at some of the actual results of this year's study. And I'm going to start off showing you a series of charts that are all organized the same way. So if you sort of understand how the first chart's organized, the next several charts are going to be the same way. Each chart's going to look at a particular measure. This looks at before tax return on net worth. So it's bottom line profits as a percentage of net worth or owner's equity. Those are interchangeable terms. And we're looking at all firms here that responded to the study, and we're looking at the last 5 years. And just looking at this, you can see that 2017 was a very good year from a profitability standpoint for the industry as a whole. It was the highest profitability over the last 5 years. Okay, looking at another measure, bottom line profits as a percentage of net sales. So this is profit margin on sales. And you can see that 2017 was 3.5%, and it's fairly close to what it's been over the years, but it did go up somewhat from 2016. Now, as I go through here, keep in mind, it's nice to know how the industry did, but what's most important is how you compare to the industry. That's where the value of this study is. So as we go through this, try to think how your performance was compared to the industry as we're looking at it. Okay, asset turnover, which is sales divided by total assets. It's a measure of movement of assets, and ironically, it has been absolutely the same each of the last 5 years. So great consistency in terms of this particular measure. Another measure, financial leverage, which is total assets to net worth. This is an indication of how much a company relies on debt versus equity financing. The higher this number is, the more leveraged the company is, therefore relying more on debt financing. Now, it's a fairly narrow range as to what this has been over the years, but it did tick up somewhat in 2017 for whatever reason. Okay, payroll costs as a percentage of net sales. Now, this is a critical number because payroll costs represent such a significant expense item for the typical distributor. And when you think that the typical distributor has fairly thin bottom line profit margins, if you are 1 or 2% of sales too high on any given expense category, that can be significant. So for the typical company in 2017, this was a 16%, which was somewhat lower than it was in 2016. This is fringe payroll costs, but including fringe benefits. And again, keep in mind how you compare to this, because this is a very critical number, and we'll talk a little bit about it later. Okay, gross margin as a percentage of net sales. Now, you'll see I have a lot of bars on this particular slide because this is the measure that was redefined 5 years ago. Historically, vendor rebates were not all that significant in the industry. When this study first was developed way back 36 years ago, vendor rebates were like 0.5% of sales. And they would therefore decide, the parties to be decided to put those into non-operating income. So they considered it more of a financial decision rather than an operating decision. Well, over the years, vendor rebates became more and more significant to the point now they're close to 6% or 5.5% of sales for the typical company. So as a result of that, most people were putting vendor rebates into gross margin, reducing cost of goods sold by the vendor rebates and putting into gross margin. So it just made sense to start showing it that way. And in the report, we actually still show it both ways. We show vendor rebates included in gross margin, and we show vendor rebates not included in gross margin, so that you can decide what you think is most relevant for you. But most people now are including vendor rebates in gross margin. Inventory turnover, which is warehouse cost of goods sold divided by average inventory. It's a measure of how quickly you're turning your inventory, the inventory that you take into your warehouse. And for the typical company, 3.8 times in 2017. And again, you can see that's been very steady over the years. Now, there is a measure in the study that combines both gross margin and inventory turnover into one overall measure of inventory management, and this is called Warehouse Gross Margin Return on Inventory, or GMROI. It's a very important measure because of the fact that some companies have a high margin, low turnover strategy. Other companies may have a low margin, high turnover strategy and still get to a good GMROI. So it's the combination measure that's most relevant to your inventory management. How is your gross margin and your inventory turnover in combination helping you? And the way to interpret this is in 2017, GMROI was 132%. That means that the typical company in the industry earned $1.32 of gross margin dollars for every dollar invested in inventory. So the typical company was earning 132% return on their inventory investment. And again, this is impacted by both turnover and gross margin. So you really shouldn't look at gross margin alone. You really shouldn't look at inventory turnover alone. You should look at this combination measure. And again, this is based on warehouse gross margin and true inventory turnover, which is based on what you bring into the warehouse. Now, there's another measure in the study called turn and earn that does the same type of thing. It's just calculated a little bit differently, but it does the same type of thing. So it's really a matter of which you're more comfortable using, and I'd recommend that you do use that as you are evaluating your inventory productivity. Total operating expenses as a percentage of sales. Again, a very critical number. And the reason it's critical, and I'll talk about it later, is because the high profit companies invariably, year in, year out, have lower operating expenses as a percentage of sales. They do a better job of expense management. So the typical company in 2017 was 24.2% total operating expenses as a percentage of sales. You can see it hasn't varied all that much over the years, but what's most important is how you compare to this. And that's why it's a critical number, and we'll talk about it. Average collection period on receivables. How long it takes you to collect your accounts receivable. The typical company was at 46 days, which you can see is pretty much in line with what it's been over the last 5 years. I think in good economic times, this number doesn't vary a lot, but if the economy starts going the other way, then you'll oftentimes find this number going up. And accounts receivable, basically it's based on average receivables, and you divide into average receivables your credit sales per day to get this number. Net sales per employee, very important personnel management measure because it shows you how productive your employees are to generate sales and to service your sales. The typical company was $457,000 in sales per employee during the most recent year. Now, the numbers on this chart are not adjusted for inflation. These are nominal dollars. So you're going to expect a little bit of inflation occurring each year just by definition, but inflation's been relatively low in the economy, so it's not all that significant. But what is significant is how you compare. So if the typical company's sales per employee is $457,000 and you're $200,000, then that would be a huge red flag for me as to what might be the issue. Maybe there's a good reason, but maybe you have too many employees that just aren't productive employees. So that's why you use this kind of measure. Percent sales change from the previous year, or sales growth. And again, you can see it was a good year for the industry. The typical company had 6.6% sales growth after the 2 previous years, sales growth having been actually lower than the previous year. But there was a bounce back in 2017. Okay, one good way of looking at your company is to use what's called the profit model. Was developed way back in the early 1900s, I believe, by the DuPont company. And it's not perfect, but it's a good overview of how your company is doing. And basically, you want to try to get to a return on assets number on this slide. And I like doing it before tax because it's not distorted by tax issues. And return on assets is profits before tax as a percentage of sales. And the way you get to these numbers, and I'm showing it here for all plumbing supply companies and all PVF companies, the way you get to these numbers is multiplying profit margin by asset turnover, where profit margin is before tax profits as a percentage of sales. Asset turnover is sales divided by average total assets. So if you multiply profit margin by asset turnover, you get return on assets. Well, the beauty of this is if you see that your return on assets for your company is not all that great, then you can go back and try to figure out the components of it. Is your profit margin low, or perhaps your asset turnover is low? If your profit margin is low, then you can further drill down to the various components of profit margin, things like gross margin, expenses, sales. If you see that your asset turnover is low, you can drill down to the various components of that. For example, how's your inventory? How's your receivables? How's your sales? So the idea here is to try to give you a framework for identifying where your strengths and weaknesses are. Now, the profit model doesn't just stop at return on assets. It actually goes to calculate return on net worth or owner's equity, which is another return on investment number. So if you take the return on asset figure that we just looked at, multiply it by financial leverage, how much a company relies on debt versus equity financing, you get your return on net worth. So where financial leverage comes in is if companies are highly leveraged, then it tends to enhance their return on net worth profitability. But likewise, if they're not doing well, say they're losing money, it enhances it the wrong way. But again, the idea here is that financial leverage is another component of return on net worth. So putting it all together to get the full strategic profit model, you have profit margin times asset turnover to give you return on assets times financial leverage to give you return on net worth. So the three pathways, if you will, for return on net worth are profit margin, asset turnover, and financial leverage. And you can determine where your strengths and weaknesses are within those. Okay, let's shift gears a little bit and look at the results of this year's study of 2017 results by industry segment. And for the OPR, we track 4 separate industry segments: plumbing supply companies, PVF companies, plumbing and PVF, and HVAC and other. Thus far, I've only looked at all firms. But what's going to be most relevant to you is how you compare to the grouping of companies in your particular segment. So just looking at this, the first chart here is return on net worth. And you can see that the plumbing supply companies had the highest return on net worth in 2017 as compared to the others. Second was the PVF companies. Looking a little further, if you look at bottom line profits as a percentage of sales, you can see that plumbing and PVF also had the highest bottom line profits. So they had the highest return on net worth, but also the highest bottom line profits as a percentage of sales. As a matter of fact, this particular chart is largely a mirror of the previous chart because bottom line profit margin is a very strong driver of overall profitability among companies. How about gross margin? Well, this is quite interesting. The two groupings, plumbing supply and PVF, that had the highest profitability and highest bottom line profitability, interestingly, had the lowest gross margin on sales among the 4 groupings. So it wasn't gross margin that drove their high bottom line profit margin. It was something else. And in a moment, we'll get a feel for what that might have been. So gross margin doesn't always dictate bottom line profit margin. And oftentimes, we become a little bit enamored with gross margin and overlook the other components of profitability. Inventory turnover. The highest inventory turnover of the 4 segments was plumbing supply companies. And you can see PVF and plumbing and PVF followed. Warehouse gross margin, return on inventory. The highest were plumbing supply companies and PVF companies, which is interesting because both of those groupings had lower gross margin, but they also had somewhat higher, or they were, at least the plumbing supply were the highest in terms of inventory turnover. How about employee turnover by industry segments? Now, this is a little bit mixed in terms of what this is showing because you can see that there's a big variation among the different groups. The plumbing supply companies had the highest employee turnover. The lowest were the PVF companies. And just for your reference, in the industry report, all of these things are defined, but I'll just read it real quickly for you. Employee turnover is defined as the percentage of full-time workers employed at the beginning of the year who left the company during the year for any reason except retirement. So that is how that's defined for this particular study. Okay, in addition to the segments, we also have information by very large companies and also by small companies. In particular, we define these as companies that are 100 million and over in sales volume size and those that are 15 million and under in sales volume size. And here we're looking at before tax return on net worth. And you can see the large companies had a higher return on net worth than did the small companies, largely driven by the fact that the large companies in 2017 had a higher bottom line profit margin before tax as a percentage of sales. And again, this chart largely mirrors the previous chart because bottom line profit margin is really driving overall return on net worth profitability. However, if we look at gross margin, and this is after purchase rebates for the two segments, you see that the smaller companies actually had a higher gross margin than did the larger companies. So the larger companies had higher return on net worth. They had a better bottom line profit margin, but they actually had a lower gross margin. And you're probably all thinking out there, well, obviously their expenses had to be lower. And in fact, that is the case. The total operating expenses as a percentage of sales for the large companies were substantially below that of the smaller companies. And that more than offset the differential in terms of the gross margin difference. Inventory turnover tended to favor the large companies, 3.8 versus 3.4 times. Warehouse gross margin return on inventory also favored the large companies, largely due to their higher inventory turnover. Okay, employee turnover for the large versus the smaller companies. For whatever reason, the large companies had a much higher employee turnover than did the small companies. And interestingly, we've had this ratio in the study for about 5 years now, and every single year that we've done it, the large companies had a higher employee turnover than did the small companies. And we can theorize why that might be, but it seems to be a consistent pattern every year. Okay, does anybody have any questions before I go on and shift gears and take a look at our case example company? It's not always easy to do the questions on these. By the way, if you have a question after the session, by all means, send me a text or call me up or whatever, and I'd be happy to discuss anything in more depth with you. Okay, let's take a look at our hypothetical company. And the idea for doing this is we can see in a very short period of time how you can get insights, hopefully about your own business, by seeing me analyze a hypothetical company. And I want to emphasize the word hypothetical because we'd never use anybody's actual results. And we're calling our company Tom's Plumbing and Heating Supply Company. So if there is a company out there with that name, I apologize. I tried to make this up all the way around. So let's say Tom has come to you and said, here's my numbers, here's my balance sheet and income statement, how'd I do? Well, again, just by looking at the dollar amounts doesn't tell me enough about his business. We need to start calculating some measures. Looking at his company over time would be a good thing because we can see any adverse trends or positive trends that occurred within his own company. But for our purposes here, we're going to look at him versus the industry norms. And I picked all ASA respondents for this example, but a better grouping would probably be companies that are similar to Tom in the type of business he is, like PVF or plumbing, and within his same sales volume category within his type of business. But for our purposes here, I'm going to use all ASA respondents. So I've calculated some measures for Tom, and I'm now going to go through the exercise of trying to see where his strengths and weaknesses are. Well, we can see his profitability. He is profitable, but his profitability is much below that of the industry. He's at 0.8% marginally profitable return on assets versus 8.9% for the industry. His return on net worth is only 1.8% versus 18.3%. So right there, I'd be raising some red flags. Tom, we need to start analyzing this. Okay, looking at some of the components of profit margin, payroll costs, including, in this case, it's without fringe benefits. His payroll costs are 14.5% of sales versus 13.2% for other companies like him. Okay, that's a red flag for me. Tom, you're 1.3% of sales higher in terms of your payroll cost than other companies. Why is that? Now, there may be a very good reason. Maybe Tom can tell us a good reason. But by the same token, maybe there's a profit leak. There's an inefficiency there that could be improved. His gross margin, including purchase rebates, was 26.5 versus 28.1%. So I'd raise another red flag there. Tom, you're not getting the gross margins and others are getting. Maybe you're making it up in inventory turnover, but at this point, I'm going to raise the red flag. His bottom line profit margin on sales, 0.3% versus 3.5%. So obviously he's marginally profitable. A big part of it might be maybe an issue with personnel costs. Maybe there's an opportunity to increase his gross margins. Sales change from prior year was good. Tom was 7.2%, the industry 6.1%. So he did okay there, so I'm not raising the red flag necessarily there. Going further, looking at some of the more detailed operating expenses, well, his selling expenses are on the high side. And Tom might argue, well, it resulted in me having higher sales growth, so I'm okay with that. And maybe that is the case. His delivery expense, pretty much what the industry was. His warehousing expense, below the industry. So we wouldn't focus efforts there. But his G&A, general and administrative expenses, are 1.3% of sales higher than the industry. So that would be of concern to me. Tom, why is your G&A expense so high? So I would raise the red flag there, and I would want to definitely look into that in more depth. His occupancy expenses, pretty close to the industry, not really an issue. Other expenses, not really an issue. So his total expenses as a percentage of sales are 26.2 versus 24.2. So he's 2% of sales higher on his expenses. And the biggest part of that was selling expense and G&A expense. And we already looked at the fact that personnel costs were high. Okay, looking at some other measures, sales per employee. Tom is well below the rest of the industry. So I'm starting to get a picture here that he has an issue with regard to his people management. His payroll costs are high and his sales per employee are low. He might have too many unproductive employees. His gross margin per employee, also low. His asset turnover is in line, but his accounts receivable days is on the high side. Now, maybe he has liberal credit terms, and maybe that contributed to his good sales growth, so maybe it's not a problem. But on the other hand, maybe there is an issue there. Inventory turnover Tom is on the low side, and warehouse gross margin return on inventory, which is that combination measure, he is somewhat below the industry. His current ratio, fairly close to the industry. His financial leverage, slightly above the industry. So those aren't necessarily big problems. But to me, his biggest issues are expense management, especially payroll costs. Personnel productivity is an issue, and he may have an opportunity to improve his gross margins also. So really, in a very short period of time, we've now gotten some direction as to where Tom's strengths and weaknesses are, and maybe some opportunities for improvement. Okay, I want to shift gears again, and this is that profit leader analysis that I alluded to earlier on. And the idea here is to take a look at the most successful companies within the various groupings and to try to identify what led to their high profitability, recognizing that they're not going to be best in every measure, but overall, they have the highest profitability. And the way we define the high profit companies is we look at one measure, before tax return on assets. So that's a return on investment number. It's a return on asset number. We look at that measure, break off the top 50% best performing companies based on that measure, put them in a grouping by themselves, and then run all the statistics for that grouping of companies. And then compare them versus the industry averages overall to see where there are differences. So here we look at sales growth. and we're looking at all plumbing supply versus high profit plumbing supply, all PVF versus high profit PVF. And for both of these groupings, PVF and plumbing, the high profit companies had higher sales growth during 2017. Now, that's not always the case, but it certainly was during 2017. Before tax return on net worth. Net worth or owner's equity, those are interchangeable terms. The high profit companies were significantly more profitable than all companies overall. And this difference would be even more pronounced if we would have looked at the high profit versus low profit companies. In other words, the upper 50% versus the lower 50%. I'm just looking at the high profit or upper 50% most profitable versus all plumbing supplies here. And that includes the high profits within that group. If we looked at just the bottom 50%, this differential would be even more significant. But suffice it to say, the high profit companies were significantly more profitable. Bottom line profit as a percentage of sales, or profit margin on sales. Again, the high profit companies did much better than all companies overall in each of these two segments, plumbing supply and PVF. So somehow the high profit companies are getting substantially higher amounts of sales dropping to the bottom line. And again, this would be even more pronounced if we looked at the upper 50% versus the lower 50%. Gross margin as a percentage of sales. Well, the high profit companies in both segments did do somewhat better. You can see plumbing supply somewhat better than all firm plumbing supply. The PVF did substantially better than all PVF companies. This isn't always the case, though. Not every year do the high profit companies have higher gross margin, but it certainly did happen in 2017. Total operating expenses as a percentage of sales. Now, this one is an important measure. In the case of plumbing supply, you can see that it was a huge difference between the high profit and all companies. For the PVF, not as big a difference, small difference actually, but if we would look at the high profit versus the lower profit or lower 50%, this would have been a more pronounced differential. So operating expenses was one area where they definitely had an advantage. Inventory turnover, for plumbing supply, they were identical. For all PVF versus high profit PVF, the high profit companies actually had a lower inventory turnover than did all PVF companies. Payroll and fringes as a percentage of sales. For the plumbing supply, there was a significant difference. The high profit companies were 0.8% of sales lower in payroll costs than all companies overall. For the PVF companies, they were actually the same. Sales per employee, however, greatly favored the high profit companies for both groups. 490,000 versus 460,000, 558,000 versus 513,000. So the high profit companies were definitely getting more personnel productivity. Employee turnover. Now this is mixed because the high profit PVF had a higher turnover, the high profit plumbing had a lower turnover. Average collection period on receivables. Actually, the high profit and the all firms were very close in this regard. Financial leverage. In the case of plumbing, that was identical. In the case of the PVF companies, the high profit companies tended to be somewhat lower leveraged. Okay, so just to summarize, the high profit companies were much more profitable in terms of return on asset profitability and return on net worth profitability, largely due to higher bottom line profit margins. They did have higher gross margins this year, and the plumbing supply had much lower payroll costs. Both had higher sales per employee, and both had lower total operating expenses as a percentage of sales, although it was less pronounced for the PVF group. Similar average collection period on receivables, and lower financial leverage for PVF, similar for plumbing, and employee turnover was somewhat mixed. So what do we get out of that? Well, basically, in doing this analysis for many years now, one of the things that really jumps out always is the impact of expense management. Year in, year out, the high profit companies have lower expenses as a percentage of sales. And I talk about something called expense creep. And that is when we have a good economy like we do now, there's a tendency for expenses to go up and not really be noticed. Because when cash flow is good, when sales are good, when profits are good, if inefficiencies creep into your business, they oftentimes are not noticed until the economy turns back around. So you really need to guard against expense creep, and that's why the high profit companies always seem to do a better job of expense management. Going back to looking at total operating expenses as a percentage of sales, plumbing supply companies had much lower total operating expenses. PVF companies, not all that much lower, but again, it would have been more pronounced if I looked at the high versus the low profit companies. Well, along with expense management goes sales growth. And both the high profit groups that we looked at had higher sales growth. And the reason that kind of goes along with expense management is because if you have incremental sales increases, you can spread your fixed costs over more sales, which drops a disproportionate to the bottom line, at least in the short term. So let me take you through a simple example. Each side of this, or the left side here, is a simple P&L or income statement. Let's say a company has $50,000 of volume. Their cost of goods sold is 80% or 50 million or 40 million cost of goods sold. They have $4 million of variable expenses, which go up and down in proportion to sales. Their fixed expenses, we'll say for our example, are also 8% or $4 million, and they have a bottom line profit of $2 million. Let's say somehow they figure out a way of getting a 10% incremental sales increase, so $5 million of new sales. Well, if they do it without a big price reduction, then their cost of goods sold is still going to be 80% of the new $5 million. So that'll be $4 million out of the new $5 million. Variable expenses, which simply defined go up and down in proportion to sales, will still be 8%. So on the new $5 million, these are $400,000. There is no fixed expenses, at least in the short term, on the new expenses or in the new sales. So as a result, everything else drops to the bottom line. So you now have $600,000 profit on the new $5 million of sales, or 12% profit margin on sales, on the incremental sales. Well, obviously, if sales go up significantly over time, then even fixed expenses go up. But I think you can see the concept here. Okay, I've talked about the importance of turnover along with gross margin. This little chart highlights that. Let's say you start off with $10 million in cash. You're in business to make money, so you buy inventory with your $10 million, and then you mark it up. We'll say 20%. This is not gross margin. This is markup. So you now have $1,200,000 of inventory ready to sell. Go back. If it was all cash sale, you have 12 million of inventory ready to sell. If it was all a cash sale, it would go up to the top as 12 million of new cash. It's likely to be a credit sale, so it'll go to accounts receivable. You'll have 12 million accounts receivable. Hopefully, it's eventually collected and goes up to the top as another 12 million that can be put through the cycle. So the idea is the more times you can put it through the cycle, then the more successful you'll be. If it gets stuck here as inventory that's not selling, then that's going to hurt your cash flow and not go through the cycle. If it gets stuck here, same thing. If you can't collect your accounts receivable or you're slow, then it's money that can't go through the cycle. So that's why turnover is important. Turnover of inventory and your accounts receivable as well. And we have the measures that we've shown already for measuring inventory. And again, it's that combination measure, gross margin return on inventory, which takes into account both gross margin and inventory turnover into one measure. Keep in mind also that if you have excess inventory, it's costing you to have excess inventory. And I don't want to spend a lot of time on this, but these are some of the things that go into inventory carrying costs. And some people think that the cost of excess inventory could be 20 to 25% of the value of the inventory. So if you have $100,000 in excess inventory, then that means it's costing you $20,000 to $25,000 just in carrying costs for your excess inventory. Again, it's important to measure your receivables. We have average receivables days or average collectibles collection period for doing that. I would suggest you also look at aging schedules of your receivables. And if you do that, you're going to do a good job of managing your receivables. Personnel management, also critical because personnel costs are such a key component of your business. And I maintain if you can incentivize employees to be successful for themselves, they will be successful for you as well. And again, we have measures for doing that, and we've already talked about those. Okay, one last thing is people oftentimes say to me, Tom, we're successful, we're growing, we're profitable, but we have no cash. And part of that is the fact that they're growing faster than their sustainable growth rate. And this little example shows you how to calculate your sustainable growth rate. And let's say you've gone through this example, and I would suggest you take a look at these slides afterwards and think about this. If you determine that your sustainable growth rate is 6% and you're growing faster than that, then that means you're probably going to need additional financing, either new debt or equity financing, and your cash flow is going to be strained. If you grow slower than your sustainable growth rate over time, then you're probably going to be kind of cash rich. So that's why I like to put that in there. And finally, if you wanted to try to narrow down this study and try to say, how do I prioritize my time in looking at this information, start off looking at just some key measures. Pretty much the measures I've just looked at, and I'm going to show you the next slide, which identifies those. Look at your own company, not try to look at all the data groupings, but pick the data grouping that is most relevant to you, and it's probably the one of companies similar in size as you. If you want, look at the high profit companies to see how you stack up versus them, and then look for areas of possible red flags. These 15 measures are ones that I would suggest that you take a look at. These are the ones, this is kind of the tip of the iceberg, realizing that you probably might have some other ones that you want to add into this or take some of these out. But the idea here is to prioritize your use of this study so that you can get a lot of information about your business in a very short period of time. And where should you focus your efforts? Well, it's the things we've talked about: operating expenses, payroll costs, inventory management, receivables. Those are the key areas. You should have received your report if you were the person whose name was on the survey questionnaire to access the portal to get your reports. This particular link is how you get to it, but only the person whose name was on the survey questionnaire as the person who was allowed to receive this information will be the person who will be able to access their information. Finally, we have a very favorable business climate, thankfully, right now, for a number of different reasons. As a matter of fact, the consumer confidence index, that was just released yesterday by the Conference Board, said that we had the highest consumer confidence since October of 2000. I'm showing you December 2000, but this was updated yesterday. So we have a very favorable situation now. So hopefully it's a good business climate for you to operate in. But the point here is you can maximize your success even in good times if you use some of this information from the OPR. And with that, I want to turn it back over to you, Ayesha, to make some final comments. And I'd like to emphasize, if anybody has any questions, probably best just send me an email and I'll be happy to respond.
Perfect. Thank you, Tom, for an excellent presentation, and thank you everybody for participating in today's webinar about the American Supply Association's Operating Performance Report. Again, this webinar has been recorded for replay, and all of you will receive a follow-up email message with notification as to when the replay is available, as well as instructions on how to access it. The presentation slides are already available on ASA's website, www.asa.net. Click on Business Intelligence and select Industry Benchmarks plus Operating Performance Report, and then scroll down to Resources. I would like to remind all of you that registration is still open for Network 2018 at the Fairmont Princess Hotel in Scottsdale, Arizona, this October 31st through November 2nd. With more than 107 wholesale firms already registered, we are well on our way towards reaching our goal of having at least 140 different distributors represented, and all indications clearly point to another very successful annual all-industry event. Visit our website for complete information. I'm Aisha Salman on behalf of ASA, and this webinar is now concluded. Good day.